Good morning, everyone. It's Ken Angst here. I'm the team leader of the Angst Real Estate team with Haute Properties. We're doing a weekly live podcast about everything that has to do with real estate. This week we have a special guest, Ron Simpkins, with Ron Simpkins CPA. Is that correct? How's it going, Ron?
Good.
Good to see you. Thanks for coming in. So this is a treat because a lot of you always ask me real estate tax questions, and I always have to refer you to your CPA. But what I've done is I've written down the top 7 questions I get from my clients, and Ron's going to give us the straight story. Ron, tell them how they get a hold of you if they want more information.
Yes, if they need additional information, they can contact me by phone, which is 775-786-1008, or my email, which is ron@simpkinscpa.com.
Okay, yeah, both of our Truckee Meadows BNI members. That's how I was introduced to Ron, and we have a lot of clients we share. So give them a call if you have questions above this. And then also you have the ability today to type in your question. So that's something new. So if anybody has a question, you can type it in and maybe we can get it going live. So here we go, rapid fire, ready?
Okay.
Okay, so one of the questions I get a lot, especially in this market, it's hot, is what is the definition of a primary residence for tax purposes, and why is it important?
Your definition for a primary residence basically is where you spend most of your time. And a couple other considerations is where you have your driver's license, where you're registered to vote, and where you have registered your automobiles. Those are the primary considerations that they determine for your primary residence.
And what's the length of time you have to live there to qualify as a...
They sell their property, they have to live there for at least 2 out of the last 5 years.
Okay, so question is, we're dealing with this right now. It's not my client or our client, but there's a person selling a home, lived there 9 months, it's bound to make like $150,000. How is that, if they're not there for 2 years, what's the tax ramifications?
They are going to pay ordinary tax rates on whatever that gain is that they have on their house. Whereas if it was their primary residence, they lived in it for 2 of the last 5 years, and it was on a joint return where both spouses qualified, they would get to exclude up to $500,000 of any gain. So that's the big difference, the ordinary tax rates versus your $500,000 exclusion from any gain.
So the moral of the story is be careful or wait 2 years before you sell a house that you moved into as your primary residence?
Yes. What I would do is I would have some professional compute what the differences in if you waited and try to anticipate where the market might be in a year from now.
That's a great point, because the market's hot, so you may actually lose out. And then obviously it all depends on what your income tax rate
correct,
is.
right.
So a higher rate person could potentially pay 40 to 50%, correct?
Well, they could go up to 37% on the federal, and if they live in a state that has income tax, yes, it would be in excess of that 37%.
Okay, so bottom line is, if you own a property, you live there less than 2 years, call your CPA.
Yes.
Or call Ron. Second question I get is what are the SALT deduction limits? Can you kind of go, and that stands for state and local tax. I guess it was implemented in 2019?
2018 under the
What
tax
is
law.
SALT taxes and how does it impact people?
It's your state and local income taxes, which is real estate taxes, DMV fees to a certain extent, sales tax, the higher of either sales tax or state income tax, and you're limited on those deductions to $10,000 on your as part of your itemized deductions. So if you live in a high property tax state like California, Connecticut, those places, your property taxes are going to be in excess of $10,000, but you can only deduct up to $10,000 on all those tax. And also that includes, like in Nevada, where we have no state income tax, but we have sales tax, you get to bring in a factor for sales tax. But again, you're limited to $10,000.
So a lot of people are building new homes, And if you're building a home in excess of $1 million and you're paying the new tax on that, 1.25%, my understanding is, for property taxes, you're above the limit.
Yes.
So you need to keep that in mind when you're looking at homes. Maybe look at state of Nevada still has that state income tax that depreciates over time. So older homes, you pay less. But if you're building a new one, you're going to pay a premium, and then you're going to be limited out on what you can write off, correct?
Correct.
So be careful on that. We get a lot of questions about that. What new topic? I get this a lot. What is the mortgage interest deduction limit?
You can only take mortgage interest up to a total of where you have a $750,000 mortgage balance. So if you had $1 million, you have to allocate that mortgage interest deduction between the $750,000 and the $1 million.
So it's prorated?
Prorated, right.
You get it to $750,000, but then it's prorated out after that.
Right.
Okay, so yeah, keep that in mind. With the large increase in prices here, $750,000 mortgages are not out of the ordinary anymore. Just because prices, I mean, there are several homes now, $2, $3, $4 million, and people take out mortgages, but you only get a write-off up to
it's $750,000.
So keep that in mind. That's a big one that's out there that's kind of nipping people, particularly in the higher end. Another thing, we're going to switch to rentals. So a lot of people don't understand what it means when you own a rental property, what it means to depreciate. First, what is depreciation? Second, how is it calculated? And third, what happens when you sell?
Okay, on depreciation on rental properties, that's a benefit. You take what you paid for those properties and you get to depreciate those over a period of time, which becomes a deduction against any rental income that you receive. So it's a benefit as you hold that rental property.
How's it calculated? Over what period of time?
On commercial property, you take it over 39 years. Mm-hmm. On residential property, you take it over 27 and a half years.
Why is it 27 and a half? I always wondering why.
That was a number that they came up when they passed the bill. They said 27 and a half years sounds like a good period of time for
I don't understand how you depreciate a half year. But with that being said, so on a $275,000 house, and how you calculate it is, and maybe I'm getting in the weeds here, but it's basically your structure minus the raw land, correct? You don't get to count raw land.
Right. You have
raw land doesn't depreciate.
Right. Whatever you pay in total, you have to allocate that between the structure and the land value.
And that's figured out at year one when you buy it, the first tax return, and that carries forward for 27 and a half years?
Correct.
Okay, so keep that in mind. So if your structure value was $275,000, you would get a deduction off your taxes, $10,000 per year. Now, call Ron, because we're not going to get in the weeds on this one. We talked about this. There's something called passive versus active income. As a realtor, I get, since it's my regular income, I get to write it off. But if you're not so fortunate, you need to call Ron and figure out how that carries forward. So we're not going to get into those weeds because that's a big one. So we're going to keep going. We're going to dive into something that's kind of out there right now that I don't really have a good understanding of, and I want to pick Ron's brain. What is the child deduction credit of 2021?
For 2021, for children from 6 up to 17, you get up to $3,000 child tax credit on your tax return. For children under 6, you get $3,600. And they just started a program. In fact, the first payments went out on July 15th. If you qualify, and what the IRS is doing, they're looking at your 2020 tax return that you filed to determine how many kids that qualify for that. And you get that, they take 1/12 or 1/6 of that amount, and that becomes a payment to you for the next 6 months. And then when you do your tax return, you take that child tax credit, either the $3,000 less what you received from these payments starting July 15th. And the payments are going the 15th of every month.
Okay, so are there, of course, there's income limits, correct?
There's income limits that if your income is above 150,000 on a joint return, you're limited from that standpoint. So you have to take those into consideration.
Okay, so you should call a CPA and find out how that works to make sure. Now, so they're basing off 2020. Now, what about people who haven't filed 2020 and filed an extension?
There's a provision that you can go to irs.gov and update your information, and then they use that information to see if you qualify. You also can opt out of these prepayments by going to irs.gov and entering the information saying that you want to opt out of the prepayments that they're doing.
What would be the advantage of doing that?
Well, you would get your full deduction at tax time. So you'd have to take a look at your tax scenario and decide if you want to have prepayment of 6 months of that child care credit taken over the next 6 months, or take the full amount when you file your tax return for 2021.
Okay, you can't. Okay, that's great. So if you have any questions about that, again, call Ron. Last question is, give me some other, if they're out there, I don't know, what are the other hot tax deductions that people are considering going into 2021?
Well, normally, your mortgage interest is one of the largest tax deductions that people have on their itemized deductions. The next area are donations to qualified charities. And there's a good thing that a lot of people take advantage of. If they have appreciated stock that's listed on the exchanges, they can give a qualified charity that stock. They don't sell it, and by not selling it, they don't have to pay tax on the gain.
Interesting.
But they get to take a deduction for the fair market value on their tax return. So I have a lot of clients that are doing that. They have, especially where the market's been the last 6 months, going up. They are saying, well, I want to give this to a church or the Boy Scouts or Girl Scouts or whatever the case might be. They can sell it, get the proceeds from selling the stock, but I get to write it off at full fair market value on the date of gift.
So, and the number one question I get, why do I need an accountant? Especially when you start getting rental properties. Man, I'm here to tell you that they're worth their weight in gold. It's critical, especially if you own any real estate, particularly rentals. You talk to Ron and figure out, because there's so many things out there that are changing on a daily basis, right?
Right. We've had a lot of tax law changes for 2020. There's a lot of tax law changes for 2021. We're required to take 40 to 80 hours of continuing education to stay on top of this stuff every year.
That's incredible.
So there's a lot of activity going on, a lot of new tax law that we have to know to do our clients' tax returns. And planning on where you might be for April 15th is a big, important step.
Get in and see your accountant now, or every quarter you should probably be calling your accountant and say, hey, I made this much money, correct? Especially if you own a business.
Right, and what you want to do is, because there's a lot of benefits in the tax code that you can take advantage of, as long as you do it by December 31st.
Right.
If you wait until after December 31st, a lot of those provisions you're locked out. So I strongly recommend that you contact a professional to make sure that you're taking advantage of every tax law that's out there.
And there's a lot. And why we're doing this podcast specifically today is, when you're buying and selling real estate, you got to have a good realtor, got to have a good lender, you got to have a good CPA, and you got to have a good attorney. Build your team. And Ron's one of the best out there. He's one of our preferred vendors. Ron, give me your number one more time.
My phone number is 775-786-1008.
And I also put in the post. Give him a call, Ron. It's always a pleasure. Thank you for answering all those questions, and we look forward to talking to you soon.
Good, thank you.
You guys take care. We'll be back next week with another special guest. If you guys have any questions in the meantime, feel free to leave us a message below, call us, or text us, and like our video.